In this week's market update, Theresa May throws away her government's majority, but markets shrug off the political earthquake. The Fed steps closer to monetary normalisation, while the Bank of England holds fire as the UK economy slows. And tech stocks, is the party over? Just when you thought you'd had your fill of political shocks, the UK's general election produced an earthquake. Theresa May's gamble blew up in her face as the country refused to give her the mandate she sought in an ill-advised snap election. From the moment at 10 p.m. on Thursday night when the BBC's exit poll predicted a hung parliament, it was clear that the general election would join last year's EU referendum and the election of Donald Trump in the roll call of recent political bombshells. Ahead of the election, almost no one expected anything other than an extension of the government's wafer-thin majority. The government enjoyed a 20 percentage point opinion poll lead at the point Theresa May decided to go to the country. It seemed like the least risky snap election ever, thanks to the perceived unelectability of the most socialist Labour Party since Michael Foot. In fact, a whole series of unexpected trends and events turned expectations on their head. These included a resurgence of interest by young voters, a widespread distaste for the Prime Minister's aloof style, a series of policy errors, including the so-called dementia tax, an unexpected warming to Jeremy Corbyn, and a weariness with 7 years of austerity. Put all of that together, and once again, the pollsters were confounded. The loss of the government's majority leaves the UK's Brexit negotiations in a state of confusion, and the future of the Prime Minister in doubt. With her credibility badly damaged by what has been widely seen as an incompetent campaign, she's not expected to hang on to office much beyond the summer. In the meantime, her government will be propped up by an uneasy alliance with Northern Ireland's Democratic Unionist Party. Without its 10 MPs, the Conservatives can't count on pushing through any of the legislation required to complete Britain's withdrawal from the EU. It's far from clear how long that arrangement can last, however, and many expect yet another election within months. Where the Brexit talks go from here is a complete unknown. No one is even very sure whether this makes a hard Brexit, with Britain leaving both the single market and the customs union more or less likely. What's certain is that the Prime Minister faces a squeeze from both sides, Brexiteers and Remainers alike. So, the political situation is a mess. The market reaction was, however, considerably more muted than those in the media and in Westminster. Markets had already accustomed themselves to the fact that the UK economy was weakening, and everyone already knew that the government was entering Brexit negotiations without a clear idea of what the best outcome would be. The election didn't change either of those perceptions. As ever, the pound was the lightning rod for political uncertainty, but here too the reaction was considerably calmer than it was following last year's referendum result. The pound fell by a couple of cents against the dollar to where it stood before the election was announced. In the stock market, the response was even more mixed. Domestic stocks in the FTSE 250 index were hit on the back of heightened uncertainty. But the international-facing blue chips in the FTSE 100 actually rose on the day as investors anticipated a further boost to exporters and overseas earners from the weak pound. This week, the Bank of England will almost certainly hold fire on raising interest rates, despite further upward pressure on inflation, thanks to the ongoing political uncertainty and growing evidence of a consumer slowdown. The UK finds itself in the grip of a sterling-fueled rise in inflation, while stagnant household earnings deliver an effective real pay cut to British workers. Bank of England Governor Mark Carney is due to speak at the annual Mansion House dinner this week. It's also attended by Chancellor Philip Hammond. He may give some insight into how the Bank of England proposes to guide the UK economy through the inevitable turbulence of the next 2 years, before the hard deadline of EU withdrawal is reached in March 2019. Further evidence of a sharp consumer slowdown was provided this week by credit card group Visa, which said that seasonally adjusted sales using its cards were 1.8% lower in May than they were in April. Visa's figures are unofficial, but they've in the past provided a good guide to future movements in the government data. Now, beyond the Westminster bubble, the woes of the UK government are less of a concern to investors. In the outside world, the big event this week is the Federal Reserve's regular rate-setting meeting. A further quarter-point rate hike to between 1 and 1.25% looks nailed on, despite recent weakness in US inflation, US job creation and earnings growth. The Fed said earlier this year that it expected to raise rates 3 times in 2017. So, while a second rate hike this month looks very likely, there's now much more doubt about whether the US central bank will follow through with another hike in September. Perhaps more interesting than the rate decision itself will be any further guidance from the Fed on how and when it plans to reduce the size of its bloated balance sheet. That's grown to $4.5 trillion since the financial crisis, as the central bank has bought government and mortgage-backed bonds to boost the economy. Withdrawing from that policy, probably by stopping the reinvestment of the proceeds of maturing bonds, is a key part of monetary normalisation. The other big focus in America continues to be the Trump presidency. Former Fed Chief James Comey was testifying to Congress last week about his dismissal by the president. All eyes were on his evidence, which some believe could be the first step along a road that will eventually lead to the impeachment of Donald Trump. Although Mr. Comey didn't pull his punches, effectively branding the president a liar, the market reaction was relatively contained. But the big market story of this week has actually not been driven by either politics or central banks, but by an old-fashioned valuation scare. The biggest driver of markets so far this year has been a dramatic tech stock rally that has borne worrying similarities to the tech bubble of the late 1990s. On Friday, it looked as if that new tech boom might have hit the buffers. The so-called FANG stocks, led by Facebook, Apple, Amazon and Google owner Alphabet, have soared by as much as 35% so far this year. That's massively outpaced the wider market, and it's driven the market higher as investors have viewed the sector as a rare source of reliable growth in an uncertain world. As prices have risen ever higher, however, investors have started to fret that such a narrow market rally is a typical sign of a late cycle market blow-off. Although valuations in the tech sector remain well below those reached in the internet bubble of 17 years ago, there are worrying echoes, and on Friday the S&P 500 technology sub-index fell by as much as 4.2%. Amazon was at 1.8% down on the day, and the sector fell further yesterday. In a further sign that investors are becoming nervous about the 9-year equity bull market, bond funds recorded their largest weekly inflows in more than 2 years last week. Almost $16 billion poured into global bond funds, with US and European sovereign bonds particularly in focus. Investors have flocked to the perceived safety of bonds despite the expectation that the Federal Reserve is embarked on a tightening cycle. And the move suggests that investors are more concerned about the return of their capital than they are about a return on it. Global equity funds, meanwhile, saw further withdrawals overall last week, with $5.7 billion being taken off the table, and that was the biggest outflow since March.